Here's the million-dollar question in the markets right now. When will the Fed cut rates? Yes, cut rates. Interest rates matter to almost all people. They have significant impacts on consumers, on businesses, and on investors. Changes in rates cause changes in decision making. That's why people spend so much time trying to forecast their direction, even if it seems like a fool's errand. Let's not spend this video making bold predictions about where interest rates are headed, and instead focus on the conditions that may lead to a rise or fall in rates. All right. In recent weeks, the market has been expecting the Fed to start cutting short-term interest rates next spring and then cut maybe another 3 times throughout 2024. That'd be a full percentage point drop to around the 4% range. Okay, the market believes this because it sees a slowdown in inflation coinciding with a slowdown in the labor market, and that possibly could be the perfect mix for the Fed. It would give policymakers room to lower rates to avoid unnecessarily pushing the economy into recession. But as we've seen time and again this year, you'll get a data point that comes completely out of left field, and then you question your entire thesis. Last week, we got the release of the November payroll report. Yes, the monthly jobs report the government puts out, and it provided that scratch-your-head moment. For months, we'd seen data showing the weakening labor market. Unemployment was rising, albeit modestly. Continuing jobless claims were ticking up. Monthly job gains and wages were both slowing. Then on Friday morning, 8:30, we get that jobs report, and we get the trifecta reversal. In November, we got the unemployment rate falling, and we also saw rising job gains and wages. So back to our question, when will the Fed cut rates? Seems less likely now that they'll start cutting in the spring, given the improvements in the labor market. As we've seen all year, as long as people have jobs, they'll continue to spend. And if they continue to spend, the Fed has to be on alert for the potential for inflation to remain above its 2% target. And that potential is what may keep them hesitant to cut rates. At the same time, there seems little reason they'll hike rates. So we're kind of in a pause mode right now for the foreseeable future. We'll soon get the latest inflation numbers just as the Fed's going to get ready to meet to decide the near-term path for rates. Here's the bottom line. It's impossible to consistently predict where the economy, the market, or interest rates are headed. As a consumer or a business owner, it's best to make decisions that keep your cash flow in line. If you're making more money than you spend, you're better positioned to outlast tough interest rate environments. As an investor, interest rates do play a role in how you value a company's future earnings, but rates do not. They do not drive that value entirely. So it's better to buy solid companies at a fair price that can perform well regardless of the rate environment. This is one reason the mega cap tech stocks have been so strong this year. They have solid earnings that can perform well without needing debt to finance their growth. If you have questions about how to position your portfolio, please reach out. In the meantime, please hit like on this video, subscribe to this channel, and we'll continue providing helpful and useful and insightful and hopefully somewhat entertaining content for you in the future.